You know, most investors are completely obsessed with stock prices, earnings reports, and PE ratios. But while everyone's glued to the news, the world's top professional fund managers are watching something much bigger, something that's, well, pretty much invisible. So let's pull back the curtain and see what it is.
So on one side, you've got the usual suspects. And look, these things are important, don't get me wrong, but they're kind of like looking in the rearview mirror. They tell you about a company's past. But on the other side, that's what the pros are watching, the overall flow of money through the entire financial system. It's a huge shift in perspective, right? It's like going from looking at one single tree to seeing the entire forest.
Okay, so this money flow has a name. It's called the M2 money supply. And honestly, getting a handle on this can give you a serious edge. It helps you see where the market might be headed before it actually gets there. All right, so what in the world is this M2 thing anyway? Well, to really get it, we need to think about the economy in a slightly different way. Imagine the entire economy is like a living, breathing person. If that's the case, then money is its blood. M2 is just the way we measure how much of that blood is actually circulating. It's basically the total pool of money that's ready to be spent or invested. And as you're about to see, it's a critical vital sign for the health of the market.
And look, this isn't some super complicated abstract thing only economists can understand. M2 is actually made up of stuff we all use every single day. Physical cash in our wallets, the money sitting in our savings accounts, and other funds that we and businesses can get our hands on quickly. It's all the money that's easy to get to, you know? And that's what makes it such a powerful indicator.
Okay, so we get what it is, but how can something as simple as cash and savings accounts possibly have the power to move the entire stock market? I mean, really? Well, the answer boils down to one super important word: liquidity. This really hits the nail on the head. And liquidity is just a fancy way of saying how much cash is floating around, ready to be invested. Seriously, think of it like fuel for the market's engine. Without that fuel, even the best companies with amazing profits can see their stock prices stall out.
So this table here breaks down the cause and effect perfectly. When M2 is growing, it means there's more money in the system. Simple enough, right? Banks start lending more, people and businesses spend more, and all that confidence just spills right over into the stock market. That creates those bullish, upward trending conditions we all love. But when M2 starts to slow down or even shrink, the complete opposite happens. The whole system tightens up, confidence gets shaky, and investors start getting really defensive. This is what the pros call a risk-off signal, and believe me, it is a massive warning sign for any investor.
So when that big red risk-off light starts flashing, where does all that money go? I mean, it doesn't just vanish into thin air. The pros, they often start pulling their money out of stocks and moving into things that are considered safer, like gold, government bonds, or sometimes they just hold on to cash and wait for the storm to pass. This is a really key defensive play that you can absolutely learn from.
Okay, now we're getting to the really cool part. The real secret sauce here isn't just about knowing what's happening right now. It's about getting a sneak peek into the future.
You see, most of the data that gets all the headlines, like earnings reports or unemployment numbers, those are what we call lagging indicators. They're telling a story about what's already happened. But M2 is a leading indicator. It drops clues about what's probably going to happen next, and that gives you a huge advantage if you know what to look for. So why exactly is it a leading indicator? I mean, what's the logic here? This timeline breaks it down perfectly. Think about it. First, the amount of money in the system has to change. Then, after that, people and companies can change how they spend that money. And only after that does the stock market finally react to all that new activity. M2 is step one. It's the first domino to fall. Okay, this is all great in theory, but how do you actually use this? As a regular investor, how do you put this to work? Let's get practical.
The pros basically follow a simple three-step playbook. First, they identify the momentum. If M2 is rising month after month, that's a green light. It suggests liquidity is good and stocks have room to run. Second, they spot the peaks. If M2 growth suddenly slams on the brakes after a huge run-up, that's a yellow light. It's a warning sign that the party might be winding down. And third, manage risk. If M2 is actually falling, that's a big red light. It's a signal to tighten up your risk management because markets almost never go up when liquidity is drying up.
And the best part? You don't need some crazy expensive Wall Street terminal to track this stuff. You can actually track this yourself on free platforms like TradingView. The ticker you're looking for is usually M2SL. You can literally pull it up on a chart right next to the S&P 500 and see the correlation with your own eyes. It's pretty amazing.
Now, a really important point here. M2 is powerful, for sure, but it's not a magic crystal ball. You've got to use it as part of a bigger dashboard. Always look at it alongside other big things like interest rate trends, inflation data, and what's happening with credit. That's how you get the full picture.
Okay, so if you remember just one thing from all of this, please make it this final, simple analogy. It is, by far, the easiest way to remember why M2 matters so much. I want you to think of the stock market like a car on a road trip. M2 is the fuel gauge. When M2 is rising, it means the gas tank is full, and that car has plenty of fuel to accelerate and go faster. But when M2 starts falling, that means the tank is emptying out. And look, the smart driver doesn't wait for the engine to start sputtering and stall out on the highway, right? No, they keep an eye on the fuel gauge so they know when it's time to ease off the gas. At the end of the day, it all boils down to this one simple truth. Markets need fuel to go higher. That fuel is liquidity. And one of the absolute best ways to measure that liquidity is M2.
So I'm going to leave you with a question. In a world where basically everyone is just watching the price, are you going to be watching the money? You now have a tool that can help you anticipate what's coming instead of just reacting to what already happened. The only question is, are you going to use it?